Hey everyone, I'm currently on vacation at the bottom of Lake Michigan, but I wanted to take a second to give you a quick summary of Jerome Powell's speech from last week. So let's jump right in. So, as you probably have heard, President Trump announced that Kevin Warsh will be the new chairman of the Fed. I'll be doing a separate video about him and some of his policies. He's actually a former member of the board of the Fed. And he's got a track record that we can look back at to predict how he might approach being the chair of the Fed. In any case, this video is not about that. This is just to give you a quick summary of what Powell had to say at this meeting. Economic activity continues to expand. Consumer spending has been resilient, but we need to point out that that is a very small percentage of consumers. The vast majority of consumers actually are having trouble spending at the pace that they were previously. So that's something to keep in mind and keep an eye out for. Job gains have remained low. Labor demand has clearly softened. But Powell says that we may be stabilizing after a period of gradual softening. I think basically they don't know what the labor market is going to do from here, so we'll have to wait and see. He points out that PCE rose 2.9% over the 12 months ending in December. Keep in mind that their target is 2%. So while PCE was almost at 3%, they were cutting rates. Some could argue that they were cutting early. But we'll see. Um, they're maintaining rates, obviously, and I think this is an important point, bringing it within a range of plausible estimates of neutral. He talks a little bit later about how they're probably at the higher end of neutral, meaning there's probably a couple more rate cuts coming. But generally, neutral would mean we don't need to raise, we don't need to lower unless something drastically shifts in the economy. So a reporter asked a really good question about how short-term rates aren't really impacting long-term rates, and I think that this gets to the crux of why I talk about this and why it matters what the Fed does. So the Fed cutting rates is going to affect short-term rates. If you have a one-year line of credit, it's probably variable based on prime. You're going to see an immediate shift in that when the Fed cuts rates. But longer term rates are based off of US Treasuries, and US Treasuries are going to be priced off of a bunch of factors outside of what the Fed does. So, inflation expectations. If the Fed cuts rates, inflation expectations can actually rise, which can actually increase the U.S. Treasuries, which can increase long-term rates. So you might hear about the Fed cutting rates and go, "Oh, great, I can get a cheaper mortgage." In fact, you might actually be less likely to get a cheap mortgage because of the Fed cutting rates. Additionally, growth expectations are a big component to this. Um, if we're expecting more growth, we're expecting real rates to rise. Rates go up. It can also growth can also lead to inflation, which once again can increase those treasury rates. Additionally, you've got government borrowing spending, which we know is not going anywhere and could very well continue to accelerate the way that it has been. Uncertainty, we've got some of that going on right now that can also push those rates up. And then lastly, foreign demand for U.S. assets. As foreign investors decide that maybe the U.S. isn't the safest play or isn't as safe of a play as it was a decade ago, they may look for alternative assets. You're seeing a huge spike in silver and gold as people flee the what we call the risk-free return of U.S. Treasuries and go to a safer store of value. So all reasons that the long-term rates can rise and why that can impact your mortgage or your machinery loan. So Powell gets pressed on inflation and how we're not at our 2% target, and I wasn't super satisfied with his answer when he says that goods prices were overshot and it's tariff related, and without saying it, he says it's transitory, right? But I think we have to make sure we define inflation the right way, and inflation is not just an increase in prices. The increase in prices is a symptom of inflation, but inflation itself is a loss of purchasing power. So if you look solely at price increases, sure, you might think inflation is under control, but there are other symptoms of inflation that may not be getting addressed, including a weakening US dollar, asset values rising in comparison to the US dollar. So when you see the stock market go on the tear it went last year, while the US dollar weakened, your purchasing power is actually weakening much more significantly than just how much milk and eggs at the store cost, right? Um, Trading down to cheaper options, that's a way that you can keep prices technically low, but quality of life actually deteriorates, and that's a loss of purchasing power. Corporate revenues rise, but margins decline. This is, I mean, we're seeing a ton of this. If you don't have pricing power as a company, you have to eat some of that cost when you have to pay tariffs, and that is a measure of inflation that doesn't necessarily get reflected directly in cost of goods. So there are a lot of things outside of just what the cost of eggs are that point to pretty significant inflation. So Kevin Warsh is a lot more intent on reducing inflation than Jerome Powell has been in recent years. And I think it'll be interesting to see when he gets in how this rhetoric changes around inflation and tariffs being transitory and things like that. But I will make a full video on Kevin Warsh and some of his ideologies and policies. So check that out when it comes out. But thanks for watching and have a good day.